I recently took a client from one of my biggest competitors out there, ChatGPT. Today I want to talk about two of the biggest myths with international tax planning that are out there that I see a lot. One is that you're just going to automatically save taxes by going international or setting up a foreign company, and also that more complicated is better. A lot of times being more complicated is not the right answer for tax planning and saving taxes in general. If this is your first time to the channel, my name's Alex McGowan with McGowan Tax, where we help individuals and small businesses save money and comply with international tax rules. This guy came to me the other day and I had a phone call with him, and he had this whole plan mapped out for taking his business outside the US. A logistics type company in the US, they had been very successful, are very successful. They were going to start doing business in Singapore. He had used, I say ChatGPT, it could have been any AI tool, but he used a tool basically to help create an international tax plan to save money abroad. And so this business is owned by two US citizen individuals. Their plan was to set up a trust that owned foreign holding company in, I think it was BVI or one of the non-tax Caribbean places. And then that holding company owned a Singapore company, which is the operating company. And they would do this logistics business in Singapore out of that. As we all know, or if you've watched some of my other stuff, if you have a foreign corporation that's owned by US people, it's a controlled foreign corporation and you're not able to defer the income necessarily, or at least it gets a little more complicated with tax planning strategy. So you can end up paying tax on income that you don't necessarily pull out of those businesses. And at the end of the day, the main strategy is avoiding controlled foreign corporation status. Real quick, I want to talk to you about what a controlled foreign corporation is. So if you run into that situation, you're not shocked and end up looking like this guy. So a controlled foreign corporation is when you have US shareholders that own more than 50% of a foreign corporation. And technically a US shareholder is a 10% or more owner in that company. So if you have 11 equal US shareholders that own shares in a foreign company, it would not be a controlled foreign corporation because they each own less than 10%. Whereas let's say you had 9 people that proportionally own this foreign corporation, they're all going to have more than 10%. They'll be US shareholders, and in aggregate, they'll own more than 50% of that controlled foreign corporation. That's bad because it subjects them to these anti-deferral rules. So you really have two different worlds. Non-controlled foreign corporation, that's just like owning a stock in any other company. So if you own stock in Apple, you're going to pay tax when you take a dividend or when you sell the stock. If it's a controlled foreign corporation, the same rule can apply, but also there's anti-deferral rules where the IRS says, even if you haven't taken money out, we're going to tax you anyway on the earnings of the company. And that could be under GILTI, Subpart F, there's a Section 956. That's where it gets more complicated. You have to file Form 5471. So that's what we're trying to avoid. Avoiding controlled foreign corporation status makes your tax return easier and simpler to file, and also avoids unnecessary taxes. That's the basic idea of a controlled foreign corporation. So what this AI tool had told them they could do is set up a foreign trust structure that owns the holding company at the top. I wasn't really clear why the holding company was necessary in the first place, but it just sounds cool a lot of times, I think, to like set up a BVI holding company, and then it would own the Singapore company. I do think the idea was they would start branching this out to other countries, and so they'd have the ultimate holding company and they could start setting up other countries underneath, which could make sense. But in this case, the problem was that the AI tool had told them that the foreign trust at the top. If you're liking this video, you should really check out my newsletter where I put out different tips and tricks, latest law changes that can really help you save money and save complexity if you're living or investing abroad. Just think how much you could save with the right tax advice. Was going to block CFC status, which is not true. So at the end of the day, if you have two US people at the top of a foreign company structure, it doesn't matter how many blocks you put underneath it to try and block that controlled foreign corporation status. It looks through these attribution rules. So basically, the only way to stop the attribution of the ownership up to the US person triggering this controlled foreign corporation status would be to actually give up control of the trust. So it's called a non-grantor trust. You'd have to pick beneficiaries and give up the ability to take money from that trust. So you kind of defeat the whole purpose at the end of the day. At that point, you might as well just give ownership of the company to someone else. So that's not what they were looking to do. So that was going to be a problem, obviously. So what we ended up doing with this client was we found a great answer for them. They were able to save money on this tax situation and as far as moving outside the US. But the holding company really didn't make sense. The trust definitely didn't make sense. So we really simplified it. At the end of the day, what we're trying to do is it's a balance between complexity and simplicity, and what are you getting out of a more complex structure at the end of the day. And a lot of times it's not as much as you think. So it's better to just go simple and not have to pay higher administrative costs. So in this case, we set up the Singapore company, we check the box on it to make it a flow through, money's flowing through, and you're gonna end up paying the higher of the two taxes. Because one thing that's important about Singapore in particular is that there's no treaty with Singapore. So when you take money out of the Singapore business, if you leave it a corporation, there's no qualified dividend rate. So you're paying ordinary income just like it was wages if you take the money out. And there's no high tax exception. So a lot of these higher tax countries, you can get an exception from the complicated subpart F and GILTI rules if you pay a high enough tax rate. Well, Singapore's tax rate's just under that. I think it's 17% in Singapore. So check the box. You pay 17% in Singapore. It flows up to you. You get a credit for that in the US and you pay the higher US rate. Simple structure. You're not in any worse position than you were before. And there's other strategies we can do on a yearly basis to try to save money in that scenario. I thought that was just an interesting example of how somebody can take something and an idea, plug it into ChatGPT or something like that, and come out with this great plan. But the problem with a lot of these tools, and I see it personally, I use them every day, is that they tend to agree with you. They're gonna take on your bias of, hey, this was a great plan, this is how I'm gonna do this, and they agree with you and map it out, and it may not be technically correct, and in this case it wasn't. We got to the right answer, but I guess that's my point, is be careful with just assuming going offshore is gonna be more tax efficient without doing real planning ahead of time. If this video is helpful for you, if you have questions on this, please reach out to me at McGowanTax.com. I'd love to talk to you personally about it. Leave a comment below. If you're in Singapore and you're having problems specifically with Singapore, let me know. Give me a thumbs up in the comment. Or if we're working in a different country or something, let me know what country you're in. I'd love to do a video about that country. Thanks for watching, and reach out to me if you have any questions.